name's Megan. Welcome back to my channel. Thank you for stopping by for another video. I figured today we would talk about getting a mortgage when you're self-employed. The house that I am in right now, I actually use my self-employment income on the mortgage application. The biggest difference that I noticed when we did our application for a house here in Texas with my self-employment income compared to our house in Washington and Alaska when I had W-2 income is that the application approval process took several days. And that is because they had to have someone in underwriting review my self-employment income before they could send us an approval. When we only had W-2 and rental income on our taxes, that application process was approved in like 1 day. The very first thing that the lender will want to see when you're self-employed is 2 years of tax returns with your Schedule C. Now this is if you're a sole proprietor. Obviously if you have a different business type, their guidelines may be a little bit different, but this is what I'm knowledgeable in. Now, if you have only been in business for 1.5 years, you will typically need to wait until you have 2 years of tax returns that you can provide to the lender. They will also want to see a copy of your tax transcript, which is basically the transmittal log that the IRS received showing that the numbers on your tax return actually match what was submitted. And this is to make sure that you didn't just grab a blank form online and fill it in to submit to the lender with some fake numbers. Now you may be wondering, what figure do you give the lender for your self-employment income? If you look at your Schedule C, line 1 is your gross receipts of sales. That is not the number you're going to give them. Go down the page and look at line 31, which is your net profit. If you did not make the same amount of money the last 2 years, you will need to average the number that is on line 31. So if last year you made $100,000 and the year before you made $50,000, your average would be $75,000. Divide that by 12 months and that will be your monthly income to put on your mortgage application. That is a standard industry practice for computing your income when you're self-employed. That goes for mortgages, vehicles, boats, recreational properties, you name it. Most lenders will use that same math to compute your income. There are also credit score requirements for the different mortgage loan types. Typically, a lender will want to see a credit score of at least 620. Some loan programs you can do a 580. But if you're self-employed, they will want to see a score that is much higher than that. And that is because self-employed people pose a higher risk to the lender. Being self-employed does not limit you to the different loan programs that are available for mortgages. You can still use your self-employment income on a VA loan, an FHA loan, conventional, an ARM, you name it, you can do any loan application you want. Most loan programs also require that your debt-to-income ratio be under 45%. Now again, if you're self-employed, they're going to want to keep that number much lower than that. The most common loan programs are VA, FHA, ARM, and conventional. Let's go over those briefly and I'll tell you a little bit about each one. If you have spent any time in the military or have a family member in the military, you probably already know what a VA loan is. But if you don't, I'll give you a quick breakdown. It is basically another option for a loan that is government-backed provided to military service members. There's no PMI, which is private mortgage insurance, that can save hundreds of dollars a month. There is normally better interest rates and no down payment requirements. Sometimes you can even roll your closing costs into the loan. An FHA loan is government insured. Typically, it is for people with the lower range credit scores and has low down payment requirements. You will have to pay PMI with this loan option if you're not doing 20% down. If you don't know what PMI is, it stands for private mortgage insurance, and that is essentially insurance for the lender in case you fail to make your payments on the loan. It's nothing for you, it is all for them to protect their investment in this property that you have purchased. You have to pay it if you have financed more than 80% loan to value. So if you're only doing a 3% down payment on a house that's worth $100,000, that means you're financing $97,000. If you put down, $20,000, then you'd be at an 80% loan to value ratio. The loan would be for 80, but the property would be worth $100,000. An ARM is an adjustable rate mortgage. Typically, they do them in 5 or 7 year increments, and you'll see it written as like a 5/1 ARM or a 7/1 ARM. What that means is that your interest rate is fixed for those first 5 or 7 years, and then every 1 year after that, the interest rate can change based off the market. There are 2 types of conventional mortgages, conforming and non-conforming. An example of a non-conforming mortgage is a jumbo mortgage, as it's called. That is for loans that I believe are over like $485,000, depending on what city you're in. A conforming mortgage fits within the guidelines set by Fannie Mae and Freddie Mac. There is also a thing called a USDA loan, which is typically provided to lower income applicants that are looking to buy property in rural areas. Now that we've got the different mortgage types out of the way, let's continue to talk about the different types of documentation the mortgage lender will want to look at. You will need to gather copies of all of your bank statements and retirement accounts, as well as any other investments, stocks, and bonds that you own. Let's talk about savings accounts for a moment. If you have zero money in savings, you should not be applying for a loan. Not only does it cost several $1,000s to actually close on a house, but you should not be buying a house if you have no money for unexpected maintenance and repairs. The lender will also want to see that you have plenty of money in reserves in case a period of time comes where your business is not doing so well. Okay, so you have 2 years of documented income, you've got a good credit score, you've got money in the bank. Let's apply for that mortgage. Assuming you get approved, it is now time to find a real estate agent and start house shopping. Now, if you don't get approved, the lender will provide you with a letter explaining the things on your credit report or their concerns that they have with your income. If your debt to income ratio is too high, there are several things you can do. You need to work on paying off bills. So if you've got credit card balances, you need to be paying those off. You've got car loans or loans for recreational vehicles or an RV, you need to get those things paid down. You can also take this time to increase your income. So higher income, less debts, that can fill in that gap that they're looking for to help keep your debt to income ratio below that 45%. If you have insufficient credit history, you need to work on building your credit score up. There are thousands of videos on that, so I will not touch on that in this video. But keep in mind, it can take 6 to 12 months to increase your score significantly. It is super easy to damage your score. One late payment can drop you tons of points. One positive payment, your score may only go up 1 or 2 points. So keep in mind, this is a process. You're not gonna make your score jump overnight. Well, that is all I have for you guys today. I need to go pick up my son from school, so I'm gonna cut it here and I'll see you in the next video.